Hello everyone, welcome to the session on financial reporting and analysis, another video on the basics part. So in this video we're going to talk about a very important aspect about the basic accounting equation. Now you must be wondering what kind of equation am I referring to? Well, this is none other than the equation for the balance sheet, which talks about asset is equal to liability plus capital. What is so critical and important about this equation? Well, the answer to that is that this equation is basically a substitute for me and you for the debit and credit. What I mean by that is that in these classes, self-paced classes, I will never be talking about the accounting from a debit and credit standpoint. I will always be talking about from a is equal to L plus C standpoint. What does it mean is that whatever transaction you guys are doing, the changes in asset will always be equal to changes in liability plus changes in capital. What I mean by that is not only at any particular point in time this particular equation will be true, but this will also be true for every individual transaction. And not only that, this equation will be used by me to ensure accounting and its quality and correctness at different points, not only in level 1 but in level 2 as well. So that said, this is really, should I say, the guru mantra for doing a very good and robust accounting. Okay, we're going to do a lot of examples based on that. Let's just look at another aspect, a smaller and an easier aspect, about the classification of activities. Now, every activity done by the business, all activity done by the business can be classified into three watertight compartments. The first compartment is the principal revenue generation activity, and the incidental activity, like payment of salary, wages, rent, etc. The second category, you all understand, is the investing activity, and I want you to let's say quickly write few words here: business long term assets plus non business any asset. Long term stroke short term. Okay, basically, if let's say I've done some investments not into my own business but into, let's say, some mutual fund, or let's say some company's bonds or some company share, that is my money but not invested into my business but invested into some other non-business activity. Now that doesn't matter if short term or long term, really is one of the investing activity. On the other hand, if I talk about the business assets, now anything which is day to day thing is here, which is operating, and anything which is related to long term asset, also called as fixed asset, also called as gross block, are called as the investing activity. Example for that, let's say General Motors buying a piece of machinery. Now they're going to make money out of that machinery by using it for over a period of time. So that said becomes an investing activity. Third is a financing activity, and just write the keyword relating to capital structure. Relating to capital structure. Okay, basically means any activity related to your debt, your equity, and your preference. What do you mean by any activity? The act of taking the capital, the act of redeeming the capital, and the act of servicing the capital by way of interest, debenture, the interest on debentures, in dividend on loan, on shares, etc., etc. So the raising part, the returning part, and the servicing part all put together, the subject matter remains your the capital. So it is not important what are you doing. What is important is a subject matter with whom you are doing that thing. What I'm trying to say is a lot of people get confused. Let's say if A is able to generate some funds by selling their investments. Now, since funds are being generated, it appears that it's a financing activity. Financing activity does not mean that the funds are being generated. Think of it. Funds could be generated by three activities. One, by doing normal business, by selling assets, and by raising loan. So funds could be generated by all three ways, but doesn't mean that every activity becomes financing activity. Okay, very critical and important from an exam standpoint. Now in the same video, I think we have time to cover up some of the important principles as well. By important principle, I mean certain fundamental thought processes that needs to be kept in mind by the accountant while doing the accounting. Again, the idea is that it's going to increase some kind of a standardization. First and foremost is the basic accounting assumption. There are two basic accounting. Actually, they are too basic to be written or told or mentioned anywhere. You will never have the going concern and accrual as an assumption being written anywhere, because there is like too basic a thing to write. What do you mean by going concern? It basically assumes that the business that you are doing accounting for is going to continue forever. What is the reason for that? Actually, this gives the company a little more time so that they can classify their assets as short term and long term. Think of it, if the entire company is going to get diluted or let's say liquidated within a period of 3 months, then every asset is going to become a current asset. Okay, then obviously the perspective by which the company is being seen, etc., will change, which let's say we don't want. So we want the company to have different accounting policy for short term things and different for long term thing. So depending on, the quality of accounting goes up. Second, and a very important, relatively much more important, is the accrual assumption. What it says is that the business transaction, the happening of it is more important rather than the cash flow associated with it. What I mean by that is this particular matrix. I want you to draw it right up with me. This is your cash, this is your accrual. Okay, and this is your income and this is your expense. So what are the words that you use? If income is in cash, is called as received, whereas income in accrual is said to be earned. Similarly, cash in expense is said to be paid, whereas accrual in expense is said to be incurred. What this principle basically means is that while accounting, the focus should be on accrual rather than the cash flow associated with it. We're going to talk about that in income statement much more detail. Some of the other principles, materiality, basically means that accounts to be prepared keeping materiality in mind. The company should not get into too much detail, nor it should be too macro. So the level of detail should be as per the size of the company. In short, the cost of making and preparing and acquiring an information should always be less than the benefit that the users of the financial statement will make out of that. Point in case, a company like Apple doesn't need to show every pencil and a sharpener and let's say a stapler that they have, because obviously as an investor we are not going to make anything out of that kind of an office stationery with them. So it is anyways too immaterial. Other principle, the second principle, very important. In fact, actually the entire insurance industry is based on that. So that principle is called as conservatism. Basically means by the actions already taken. I want you to write this word. By the action already taken. I'm not going to explain this to you right now. I'm going to explain this while we're doing long-term contract as part of the income statement. But just wanted you to write it down. Basically means that whenever you have, let's say, accepted a project or you're doing something, you are under a sales transaction or anything, and you foresee a loss happening because of that, you should prepone that loss, before the next year comes. But if there is a profit that you can foresee, don't prepone that as much. As a principle, as a matter of conservatism, we would like you to prepone your bad newses and let the good newses happen. Only then we are going to book it. So it basically is a little sad, is a little negative, but at the same time it's a little defensive principle to follow. Substance over form is again one of the very, very important aspect, and here I want you to write a couple of things. One, convertible preference stock, and second is operating versus finance lease. What I mean by that is convertible preference stock is actually legally a share, okay, a preference share, but in effect, Since it is convertible and there is large chance that it is going to be converted, it should be treated like equity share. So legal form is preference share, but it should largely be treated like an equity share. Another very relevant example is your redeemable preference share. Now again, redeemable preference share behaves like an equity, but since redeemable, they sometimes have a flavor of debt. So as a analyst or as an accountant, if I see my preference shares being the normal preference shares, I will club them under equity. For example, I am calculating my debt to equity. So the preference shares are going to be included here in the denominator if normal. But if not, that means if redeemable, I am going to take them out of equity and put them back in the debt. Preference shares might complain that, hey, I am not a debt, I am an equity, so classify him in the denominator. But I'm going to, as an accountant, tell him that, boss, I have a problem of substance over form. I'm going to look at your basic substance rather than looking at the legal form, that you are into. So that's how, you calculate your substance over form, some of the very, very important aspect from an exam standpoint. Another some of the principles, the core principles for financial statement preparations, some of them we have already done, is fair representation, the going concern, accrual basis, consistency, materiality, aggregation, no offsetting, and asset against liability. One of the thing I would like to explain, this we have done, this we have done, this we have done, materiality we have done. Consistency is something which is very critical. Let's say we have been saying that the game of accounting is driven by accountancy, the set of rules, principles, standards which the law has allowed us to use. Now, let's say we're talking about something called as depreciation. For a small thing like depreciation, the law allows us the use of 4 methods. Okay, in some country even more than 4. And it is up to the company to choose, let's say, do they want to get into the first policy. The point is, we are not, as a law, we are not going to question the policy that you have chosen. But once chosen, you got to stick to that and not change it every year. Because the moment you do that, you change every year, there is a perceived conflict of interest that comes up, as if something wrong is, or something fishy is happening. Okay, you might be absolutely bona fide intention, but nevertheless, I mean, what is important is what is the other guy who can kind of think and all that stuff. So keeping that in mind, is always better to choose anything. The law says we are not going to question that, but once chosen, let's say you have chosen particular depreciation, or let's say a particular inventory policy, then you got to stick to that very, very strictly. Okay, so with that, I'm pretty much at the end of it. The aggregation and no offsetting is pretty simple, that you can sometimes, you are allowed to aggregate the similar items and separate things which are different. Okay, but as a general rule, what we are saying is that the assets and liabilities are typically to be segregated rather than being shown in a net of form. I want you to write here pension asset versus pension liabilities. I'm going to talk about that in level 2, but I just want you to make a good set of rules for us. So this is like, if pension asset is less and liabilities are more, the asset go on the other side and is reported as deduction, whereas the opposite happens if the assets are more and liabilities are less. Depends upon what is more and what is less, so one become contra for the other. The idea is, here is 80, here is 70. The 70 is going to come here being shown under liability as negative 70, and a net liability of 10 is going to show up. Okay, this is what the accountant will be doing, but the law is saying that you should not do that, because if we do that, imagine there is a liability of $70. That means the company is not a risk-free company. But the moment you show that, it appears, because now the debt, the pension liabilities, the obligation have been transferred on the other side with a negative sign. Therefore, it appears that the company becomes a debt-free company, and the total asset also are only 10. So unnecessary, everything gets netted off, and the size get reduced. So there's a general saying, in like I said, in US GAAP and IFRS, that let's not unnecessary, offset things with each other. Let's not unnecessarily offset things with each other. Okay, so this was my one of the very important videos on the basics and the foundation. So I look forward to speak to you in my forthcoming session. Thank you very much.